This is the video lecture on note receivable. Now, in a previous lecture, we talked about accounts receivable. Well, now we need to take a look at note receivable. And a note receivable, it is an asset, and it does represent a situation where a customer owes us money. But in a note receivable, the situation is a little bit different. And there are actually two key differences. And if these two differences are in existence, then we definitely have a note receivable rather than an account receivable. Now, here are the two conditions that have to be met. First of all, it must be a written promise. In other words, there's some type of a contract, some type of paperwork in existence that documents this receivable and serves as a written promise. And secondly, we are charging interest on this particular receivable. So if those two conditions are met, this should be recorded as a note receivable rather than an account receivable. Now, in order to account for note receivable, we have to understand a little bit about interest. And interest is a topic that we really haven't dealt with before, at least not in this particular course. But as you move forward in your other accounting courses, you will eventually have a lot of dealings with interest. So in order to record the note receivable, we at least need to understand basic interest calculations, so that way we can record these when we do our journal entries. So first of all, on interest, we need to be able to calculate what is called simple interest. And simple interest is generally calculated for any interest situation where the time period is less than a year. So if it's 1 year or less than a year, generally we would use simple interest. The formula for simple interest is principal times rate times time. Now, to look at each one of these components specifically, first of all, the principal. Now, the principal, that is the amount of the debt or the amount of money that we are lending, or it could even be the amount of money on a sale. But that's actually the money that the person owes us. That's the principal. But then we have the rate. And the rate is the amount of interest that we are charging that person. And we actually would charge different rates of interest depending on the customer. The more risky the customer, the more interest we're going to charge. But if it's a reliable customer, someone who's been a loyal customer for years, then perhaps we would, let them borrow money or let them charge a sale at a lower rate of interest. And then time is a factor because interest rates are actually for 1 year, but the time period involved will probably be less than a year. So as a result, we have to account for that. And the way it works is we use banker's interest, and banker's interest is based upon 360 days rather than 365. And of course we know that there's actually 365 days in a year, but banks use 360 because that way they make a little bit extra. They make a little bit more money on the interest. So in all the interest calculations that we do, unless they specify otherwise, we will always use banker's interest, which is 360. Now, to see this in an example, assume that we're going to lend a customer or a client $2,000. But evidently, we're going to require them to sign a written promise, and we're going to charge them interest. So this is a note situation. Now, we're going to lend them this $2,000. We're going to charge them 5% interest. And this is for a time span of 90 days. So at the end of 90 days, they not only owe us $2,000, they owe us more than that. They owe us the $2,000 plus interest. So the question is, how much? Well, they actually owe us $25 in interest. And where does that $25 come from? It comes from the simple interest formula. Principal times rate times time. So in this case, the principal is the $2,000 being borrowed The rate is the 5% interest, and notice that for calculation purposes, I have that as a decimal. The decimal equivalent of 5% is 0.05. And then time, it's 90 days, but I set that up as a fraction, 90 out of 360. Again, remember, we use banker's interest, 360. So 2,000 times 0.05 times 90 divided by 360, rounded, is $25. So when they pay that money back, they actually have to pay us $2,025. Now, to see how this would work in an actual example with journal entries, in this example, we're going to loan $1,000 to a customer. And this person is going to sign a written agreement. It is a 90-day, $1,000 note at 10%. They're going to sign this on January 1st, and we're going to record this as a journal entry. So the way this works, I will debit note receivable rather than accounts receivable for $1,000, and I will credit cash because I'm loaning them and giving them $1,000 cash. Now, the subsequent journal entry is several days later, at the end of this accounting period, they have to pay me the money back. When they pay the money back, they pay the principal plus the interest. And I've gone ahead and calculated that. I debit cash for $1,025. And of course, the $25 comes from the circumstances in this particular example. This was a different principal, but it was a different rate and a different number of days. So that turned out to be 25 interest as well. So 1,025 cash is received. I eliminate the note receivable with a credit of 1,000, and that additional $25 that I received, that's actually revenue, and it's interest revenue. So I made $25 on this situation. So sometimes we would do that by lending money. Not only does it help that person because they needed the money, but it's also a business opportunity for us to make a little extra on the interest. Of course, then again, it is risky. Yes, this one worked out nice and we did get the money and we got the $25, but we did face the possibility that the person might not have paid us back. So it's always a risk. And like I said, the riskier the person is, the more interest we're going to charge because of that. Now, moving forward, we need to talk about accruing interest. Sometimes there is a unique problem that arrives, and that is a problem that must be overcome. And this happens whenever we have a note, and specifically if the note is signed near the end of the year. See, anytime we get close to the end of the year, that's always a problem for an accountant because we have certain things that started in that year that are not going to be fully resolved until the next year. So we're going to have a transaction that is spread out over 2 different years and 2 different accounting periods. So whenever that happens, that's going to cause us to have to do some extra work and some extra journal entries in order to accrue the interest. So in this example, this is another note. This time it is a 60-day, $2,000, 5% note. But notice this. It's occurring on December the 16th. That's a red flag. It's close to the end of the year. So that sends me a signal that this is going to be a problem. And it's a problem because it occurs in the current year, but we will not be paid until next year. So that's going to cause us to have to make some adjustments. So the initial journal entry on December the 16th, when I lend that $2,000, I will debit note receivable $2,000 and credit cash $2,000. That's recorded on the first day. But then I get to the end of the month. On December 31st, it's now not only the end of the month, it's the end of the year. It's the end of an annual reporting period. So at this point, even though I have not been paid, I'm going to have to accrue the interest. Now, I'm not going to accrue all the interest. This is a 60-day note, but I want to accrue enough interest for the current year. So if they sign this note on December the 16th, and it is now the 31st, 15 days have transpired. So I actually want to calculate only 15 days worth of interest. And that's going to be principal times rate times time. The $2,000, the 5% rate, 15 out of 360 days. So I'm going to have to accrue $4 worth of interest. And the way I do that is I debit interest receivable and credit interest revenue, because I've earned $4 of that interest even though I have not received it yet. And interest receivable, just like accounts receivable or note receivable, it is an asset. And then I have the final journal entry. The following year, February the 14th, it's now been 60 days, and now the customer is required to pay the note. Now, when they pay me the money, I'm not just going to get the principal, I'm going to get the principal plus interest. So in this case, it's the entire time span. It is the $2,000 principal times 5% times the entire 60-day time span. So that means the total interest is $16. So when I receive the cash, it is a debit of $2,016. But on the credit side, when I credit the receivable to show that it has been settled, it's only $2,000, and I have a $16 difference. Now, a lot of people would mistakenly credit the entire $16 to interest revenue, but you can't do that. We actually have already recorded $4 of that revenue. Plus, I have unfinished business left over from the last time period. I had an interest receivable, which was a debit. Well, now it needs to be a credit because it's no longer receivable. I've received the money. So I actually only want to credit interest revenue for $12, and the remaining $4 goes to the interest receivable. And that way, not only does the journal entry balance, but it matches the interest revenue to the appropriate time period. So think about it like this. Even though I didn't get this $16 until February the 14th, if I back up, $4 of that was earned last year, and $12 of that was earned in the current year. So we always have to have an accrual for interest anytime we have a note that's signed near the end of the year.